Okay guys, next topic is budgeting or budgets. Variances topic is actually after budgets, but I like to do variances before budgets because then you are able to understand the meaning of budget, the reason we do budgets. There are two sections to budgeting. One is the theoretical part and one is the practical part, the numerical part. So my style usually is I do the numerical part first, and then if there are any theoretical bits I do after the numerical, because once you have seen something practically, which in ACCA means numerically, then you are able to understand the theoretical bits. A short introduction: what is budgets is plan, because when high level strategic plans are made, they are for long terms, and then when they're divided into lower level, they becomes number, and one of a part of that planning is budgets. So one of the main reasons we do budgets is for planning and control. So with budget, we are thinking about the future. Without budget, we will not be worried. With budget, we will be a little bit worried about the future. And the control bit is when we do variances. Because what basically variance is that you compare actual with the budget. There are many more theoretical bits as well, which we will do in the second part after we do the numerical bits. For now, we will look at the type of budgets according to area that they cover. There are many types of budgets. So here our focus is the area. So according to the area, a budget could be a functional budget, which means it is prepared for a specific function, which basically means department. So we have departmental budgets specifically made for a specific department, and then we have master budgets, which are prepared for the whole organization. So master budgets cannot be prepared for a specific department. It doesn't make sense. And using those departmental budgets, the components that are included in the departmental budget, then they will be added together to make something called master budget, which basically means a budget that is coordination of whole organization. So that is one of the reasons we do budgeting, to do coordination. So when we prepare budgets for a specific department, that is called functional budget. And when we prepare it for whole organization, that is master budget. Departmental budget you have in F2 is the sales budget, which is prepared for sales department. You have production budget, which is prepared for production department. You have labor budget, which will be prepared for HR. And then you have material budget, which will be prepared for store or purchasing department, whichever department is responsible for whichever area. And then we have master budgets, which is like in F3 you saw P&L, SFP, and statement of cash flow. We have the same things here, but instead of looking at the past year, it looks at the future. So it is exact same thing. The idea is the same. Obviously, because this is management accounting, it will not be that much formal. It uses the concepts of management accounting. So we have budgeted P&L, which will be exactly the same as P&L, budgeted as FP, and then we have cash flow budget. We don't make Statement of cash flow, we make cash flow budget. We could make budgeted statement of cash flow as well, but it is not something that will be asked in F2 or in any ACCA paper. I've seen it in CMA, budgeted statement of cash flow, but I haven't seen it in ACCA papers. So the only thing you need to prepare is cash flow forecast, which is a lot simpler than the statement of cash flows. In statement of cash flows, you have to put things in the three categories. Very complicated idea. You will see in F2 it is very easy. So whenever we are making budgets, we will look at the whole budgeting process as well when we go to the theoretical bits. But in terms of numerical bits, the budget that we usually start with is something where we have limiting factor. Anything that is limited within an organization, we will start our budget from there. For example, if material were limited in an organization, we will start our budget from material. If cash was limited within an organization, we will start our budget from there. Because we will not be able to do more than what is the limit. In exam, the limiting factor is mostly going to be sales. Every organization, when they make budget, they mostly have sales in mind. So they don't want to do over what they're able to sell. They don't want to do under what they're able to sell. So you will be doing sales budget in exam when sales budget is made after that. And usually sales budget will be given to you. There isn't anything complicated about it. It will be straightforward. So in exam, I expect you will be doing the production budget, or you will be doing the labor budget or material budget. Because questions are 2 marks questions, so you will not be doing all of these things. You will be just doing bits and pieces. And when we are doing master budgets, obviously for SFP, you need the P&L bits, because the profit goes to the balance sheet. Once you have made the P&L budget, you will be able to make SFP budget, and then it would make sense to make the cash flow budget. Okay, so let's directly start with production budget. As I said, sales is straightforward. There is nothing complicated about it. It will be given to you. So mostly you will be starting with production budget. So required, prepare the production budget and direct labor budget for 2013. Remember, you will not be able to do labor budget before production budget. So this is the sequence. So you will not be able to make production budget if you don't know how much the sales is going to be. You'll not be able to make your labor or overheads. You could have overheads budget here as well. So you will not be able to make those budgets as well before the production budget. Okay. Pearson manufactures 2 products P&L and is preparing his budget for 2013. Both products are made by the same grade of labor, grade G. The company currently holds 800 units of P, 1200 units of L in inventory, but 250 of these units of L have just been discovered to have deteriorated in quality and must therefore be scrapped. Budgeted sales of P are 3,000 units and of L are 4,000 units. Provided the company maintains finished goods inventory at a level equal to 3 months sales, grade G labor was originally expected to produce 1 unit of P in 2 hours and 1 unit of L in 3 hours at an hourly rate of 2.5 per hour. In discussion with the trade union negotiators, however, it has been agreed that the hourly wage rate should be raised by 50 cents per hour, provided that the time to produce P and L are reduced by 20%. So remember, there are two budgets we are making. One is the production budget, another is labor budget. So focus on one thing at a time. So production budget, if our sales were equal to, if we didn't have any opening or closing inventory, our production budget would equal whatever we are selling. If there was no loss, if there was no opening or closing inventory, we would produce as much as we would sell. So if sales for 2013 were 10,000, we would produce 10,000. It would make sense. But in exam, it is not going to be that simple. Obviously, there is going to be opening or closing inventory. There is going to be losses, which means we have to produce more or less than what we sell. If our closing inventory is expected to increase, we want more units to be remaining in inventory than opening, then our production would be more than our sales. If our closing inventory is going to decrease, we would produce less than what sales, because we already have opening inventory. So the formula is whatever we are selling plus what we want at the end minus what we already have. In this question, the company currently holds 800 units of P. So let me write that in opening inventory. $1,200 units of L. So currently holding means opening. But 250 of units of L have been discovered to have deteriorated. It means they are not in good condition. Out of 1,200, 250 are not usable. So it means good inventory is 950. And therefore must be scrapped. Budgeted sales of P are 3,000, L 4,000. So we want 3,000 units, 4,000 units. Provided that the company maintains finished goods inventory at a level equal to 3 months sales. So our sales for the year are 3,000. They are for the whole year. So budget sales of P are 3,000 and 4,000. We want 3 months sales to be closing inventory. Remember, there are 3 months in a year, so you could divide it by 4, or you could divide it by 12, multiply by 3 months, which should give you the same result. So if I divide it by 4 directly, or divide by 12, multiply by 4, do it like that. But to be safe, on the safe side, always do it like this. Always divide by months and then whatever months is needed. So the same thing is here. We need 3 months sales. So our production would be, adding all of them, 2,950 for product P and 4,050 for product L. We are producing product P less than we are selling because our opening inventory is more than the closing inventory. We are producing L more than we are selling because our opening inventory is less than closing inventory. So here, closing inventory is increasing. Even the opening inventory was greater, but some of them was not in the good condition. So if opening and closing inventory was the same, let's say this was also 750 and this is also 750, then we would be simply producing what we are selling. Next is labor budget. Originally, we expected to produce 1 unit of P in 2 hours. Okay, we have already calculated production. See, this is why you cannot make labor budget before the production budget, because you need to know units. So we have 2 hours originally for product P, and product L took 3 hours. That means originally $5,900 hours and 12,150 hours. In discussion with trade union negotiators, however, it has been agreed that the hourly wage rate should be raised by 50 cents per hour, provided the time to produce P&L are reduced by 320. So our original rate is 2.5, 2.50, but we have increased that by 50 cents. So now it is $3. So we have increased the rate because the union said that the rate is lower. So we told them, but the labor is working slower. So they guaranteed us that they will work faster. It means they will take less time. It means now they will take only 80% of the time that they would normally take. So 0.80 or multiply by 80% gives you the same thing. So directly multiply by 0.80. So now they take lower time, but we give them higher rate. Remember, 20% deducted from 100% gives you 80%. So 14,160 would be the cost of labor for P, and 29,160 would be the cost of labor for L. Next question, prepare production budget, labor budget, and problem. Okay, Canaveral manufactures a single product, the clothes with a single grade of labor. Its sales budget and finished goods inventory budget for period 3 are as follows. We have sales 700, opening inventory 50, closing inventory 70. The goods are inspected when production work is completed, and it is budgeted that 10% of the work will be scrapped. The standard direct labor hour content of the clothes is 3 hours. The budgeted productivity ratio for direct labor is only 80%, which means that labor is only working at 80% of efficiency. What it means is that the 20% of the time is wasted. The thing that would take 1 hour, now it will take 20% more than that 1 hour. So 80%, remember you saw in labor ratios, efficiency when it is lower than 100%, it means they're working slower. So 100% would mean, according to standard, lower than 100% would mean slower than standard. The company employs 18 direct operatives who are expected to average 144 working hours each in the period 3. So required, the first thing that they've asked, prepare production budget. Simply looking at the demand, which is 700 plus closing inventory, which is 70, minus opening inventory, what we have is 50. This is the units we need to produce, which is 720. But 10% of the units are scrapped. So it means that what we are producing, only 90% will be good. So we have to produce 80%, 800 units, 10% would be wasted. So we would have 720 units. So 800 minus 80 will give you 720. Now labor budget, production is already there. The hours per unit, 3 hours. Now these are total standard hours. If labor works at 100% efficiency, then 2,400 hours will be needed. But they work at 80% efficiency, it means 3,000 hours will be needed. So if they waste 20% of time, 600 hours would be wasted, then we would have 2,400 productive hours. In third step, they ask what is the problem that is revealed. Now if we look at the hours needed, we have 3,000 hours. Hours available, we have 18 employees which work 144 hours each. 18 multiplied by 144. So we have 92 hours available. So we have deficiency of 408 hours. 408 more hours are needed. So suggest the problem and suggest how this problem might be overcome. So one thing we could do is improve efficiency. If you see here, labor is working at 20% less efficiency. If they were working at 100% efficiency, we would only need 2,400 hours. So then there would be no deficiency. We would actually have more hours. So one thing could be improve efficiency. Another thing could be employ more staff, maybe make this 22. Another thing we could do is reduce wastage units. If you originally saw we were wasting units, if units were not wasted, then we would need less hours. Or update technology, maybe according to the current technology we are working slower, or deploy experts, maybe the current stuff is working slower, expert would be able to make it a little bit faster. Now practically, remember, you don't have to focus on one thing at a time. You could improve efficiency a little bit, you could improve with the wastage a little bit, you could employ one or two staff. So you can do improvements from all different areas. Next, we have prepare material budget. Now in material budget, we have two budgets. One is material usage budget and another is material purchase budget. Material usage budget is how much material is going to be used in production. Now material purchase budget is how much we are going to purchase. Now if we have material already in inventory, obviously we will purchase less. If we have already material in inventory but we still want some material to be left in inventory more than the opening, then we will purchase more. So just like in production budget, if closing inventory of raw material is expected to increase, then we will purchase more than we use. They've asked about material purchase budget, but in this question you will see we will not be able to produce material purchase budget before we have produced the material usage budget. We will not be able to produce material usage budget before we have produced the production budget. So we will produce production budget, then we will be able to produce usage budget, and only then we will be able to make the purchase budget. So even though they have asked for a specific budget, you will not be able to make it directly. Taylor manufactures two products W and S which use same raw material R and T. 1 unit of W uses 3 liters of R and 4 kilograms of T. 1 unit of S uses 5 liters of R and 2 kilograms of T. A liter of R is expected to cost 3 and a kilogram of T 7. Budgeted sales for 2012 are 8,000 units of W, 6,000 units of S. Finished goods in inventory at 1st January 2012 are 1,500 units of W, 300 units of S. And the company plans to hold inventories of 600 units each product at 31st December. Inventories of raw material are 6,000 liters of R, 2,800 kilograms of T at 1st January. And the company plans to hold 5,000 liters and 3,500 kilograms respectively at 31st December 2012. Warehouse and stores managers have suggested that a provision should be made for damages and deterioration of items held in stores as follows. Product W lost 50 units, product R lost 100 units, material R 500 liters, and material T 200 kilograms. If you want to read the question again, you can just pause it and then read it again, and then you could look at my solution. So in questions like these, focus on one thing at a time. So the first thing we will focus on is the production. So which is simply the demand. Budgeted sales are 800 units here, and we have 600 units here. Sorry, 1,000. Okay. And finished goods inventory at 1st January, which means opening, but always focus on the date. Maybe 1st January is closing. So our 1,500, they already are available, which means minus and 300 of S. And the company plans to hold inventories of 600 units of each product. So we want 600 units of this and 600 units of this. Inventories of raw materials 6,000 liters. We don't need this information for production budget. The warehouse and store manager have suggested that a provision should be made for damages and deterioration of items held in store as follows. And then some of the items is going to be damaged. Product X 50 is going to be lost, and product S 100 is going to be lost. Okay, so our production we can find is 7,100 units and 6,300 units. These are good units, but 50 of these units is going to be lost and 100 of these units is going to be lost. So we need total production of 71, 50 and 6,300. So once we have done our production budget, we can prepare our material budget. But material budget is divided in two parts: the usage budget and the purchase budget. Usage budget is simple, taking the units that we have calculated above and multiply by the usage. So we have two things here used. 1 unit of W uses 3 liters of R. W uses 3R. And 4 kilograms of T. It uses 4 kilograms of T. And then 1 unit of S uses 5R2T. 5R2T. So if I add it together, we have 53,450 that is used in R is used, and 41,400 T is used. Now we don't purchase what we need in production. We might produce more. We might purchase more or less depending on the wastage and depending on not wastage in production. Wastage in production is already considered here. Wastage of raw material in the warehouse, or maybe in delivery. So now we will prepare the purchase budget. Once we have our usage of R and T, we want closing inventory of raw material. Inventories of raw material are 6,000 liters of R, 2,800 kilograms of T. We already have this. We have 6,000 and 2,800. Closing inventory, and the company plans to hold 5,000 liters and 3,500 kilograms. We want 5,000 and 3,500. So total material purchase, if there was no waste, would be 52,450. We are purchasing less than we need because we have opening more than we want closing. And this one we are purchasing more because we want more closing than the opening. But there is loss. 500 will be lost in warehouse and 200 would be lost in warehouse. So 500 and 200. That means total purchases, including losses, would be 4,200, 5,200, 950, and 4,200, 42,300. And then the price is 3 and 7. This sold at 3 and this is at 7. So total cost let's remove the dollar sign here. $158,850, and then let me do this 296,100. Okay, so this is functional budget. I will stop this video here, and the next video would be the master budgets and the flexible budget, the fixed budget and the flexible budget.